in trade on the back of hopes that more money in the hands of people will mean more consumption. One such area that everybody has their eye on is housing. Well, let's go across to this big CNBC TV 18 exclusive then. My colleague Ritu Singh is in conversation with none other than Mr. Keki Mistry to gauge the impact of the 7th Pay Commission recommendations being accepted.
We have a very special guest with us, the top boss at the country's largest mortgage lender, HDFC Limited. Mr. Keki Mistry, thank you so much for joining us on CNBC TV 18. The Cabinet has just approved the recommendations of the 7th Pay Commission. I wanted to understand from you, what impact would this have on housing finance companies like yours? Will it result in higher transactions for companies like HDFC?
Without getting into specifics on what it does for any one company, per se, the Pay Commission is obviously going to result in more money in the hands of people. And we have seen historically that whenever people have more money, consumption increases, whether it is consumption in the form of buying white goods, whether it's in the form of buying houses, consumption, or buying cars or buying two-wheelers, consumption always increases. Yeah. And as consumption increases, demand increases. When demand increases, you will typically see that there is a pickup in the investment cycle. So just to go back a little bit, when we look today at the urban economy is doing very well. We see this on a day-to-day basis. If you go to a shopping mall, all shopping malls are running with reasonable capacity. People are shopping, people are buying goods. You see hotels and the performance of hotels. Occupancy rates in most hotels has gone up significantly. Car sales have gone up. Restaurants are doing well. So urban consumption is very strong. It's the rural economy which over the last 2 years has been relatively weak, largely on the back of the poor monsoons we've had. This year, hopefully with good monsoons, coupled with the fact that the government in the last budget has had this huge focus on spending in the rural economy, infrastructure in the rural economy, a combination of government spending and good monsoons will result in more money being spent or more money being available in the rural economy to spend. Yeah. So a combination of increased demand in the urban and the rural economy topped up with this Pay Commission increase, I think a combination of all of that will result in a significant increase in demand. And as demand increases, capacity utilization will start going higher. Today, capacity utilization is about 72%, and we start seeing industries making investments once you see a capacity utilization going to 80%. So I have no doubt in my mind that all these factors taken together will result in a significant revival in the investment cycle with a lag. So there will be a bit of a lag. It's not going to happen tomorrow.
But in your experience in the past years when, pay hikes have happened, what kind of proportionate increase in housing demand have you seen from your experience?
See, when we look at the urban market, forget the urban or the rural market, but if we look at the tier 2 towns, tier 3 towns, you look at the outskirts of big cities, demand for housing has not come down at all, notwithstanding any data that you may have. We see this on a day-to-day basis. When we look at our disbursements year on year are going higher and higher compared to what they were in the previous year. You should never look at outstanding loan book because that gets influenced by selling of loans. It'll get influenced by interest rates in the economy. You should look at disbursements. And we see rapid growth in disbursements every year. So what is not growing or what has slowed down is the big ticket, big housing projects, the large price projects, the expensive housing, that has not grown. But the outskirts of big cities where we are typically catering to loans of, say, 25 lakhs of rupees on a pan-India basis, that market continues to remain strong. Historically, we've seen that whenever there is more money, like you take 2009-10 as an example, not necessarily a pay commission, but in 2009-10, in 2009, companies cut down on bonuses. 2008-10 post-Lehman crisis. And in 2009, things started getting much better in the second half of the year. And in January 2010, most companies paid huge bonuses to their employees because in the previous year they had not, and therefore they sort of made up for it. And we saw record growth in that first quarter of 2010. So if you see the January to March 2010 quarter, we've never had that kind of a growth ever in percentage terms.
That high, yeah.
So there is obviously an impact. More money means more consumption. More consumption will ultimately translate also into housing.
Is it then safe to assume even the repayment cycle would improve from here on?
So the repayment cycle for the retail segment has again not changed at all. See, the larger market, when you're talking of the corporate sector per se, corporate sector, my personal view is that if you were to look at 2008-9 and you look at 2015-16, in my view, 2008-9 things were a lot worse than they were in 15-16, because that was the first time when in India we saw job losses and companies actually shutting down factories. 2015-16, we've not seen that. But the level of disclosure that we have now in 15-16 is a lot higher, a lot better. There is much better transparency today than was the case in 2008-2009. So if we had done a similar sort of a review in 2008-9, we'd probably have seen NPAs as bad as they are now, or probably even higher than what they are now. So, and then in 2010, once the economic activity revived, things started getting better. A lot of these NPA problems got resolved on their own. And my personal view is that as the investment cycle picks up, which it will with a bit of a lag, the NPA, a large part of the NPA problem will get solved by itself as economic activity
So now
picks
that
up.
we're talking about 7-8% growth levels over the next few years, you think the NPA problem, is that sufficient to resolve the big bad loan problem that the banks are currently facing?
I can't get into numbers because I don't know all the numbers, but if you take 100 rupees as the, or 100 as the total, the level of NPL in the system, I would say more than 50%, probably closer to 60% of that will get resolved once economic activity really starts picking up. It won't happen immediately. It'll happen with a lag.
Right.
The remaining 30-40% of the NPA problem will have to be tackled on a case-to-case basis.
But
which
the
is
other
very
thing
specific
that
to each
also
bank.
precedes growth is credit growth in the economy, which hasn't happened. It's been in single digits, 8.5% for the last couple of years. Why has that happened? And do you think this time it will follow after growth happens? Is
See,
that
credit growth is a function of two things. It is a function of the willingness of banks to lend, and it is a function of demand for money.
Yeah.
Now, demand for money comes in from the corporate sector only when companies are building new plants. They are starting a new business, and therefore they need to start a new plant and machinery. They need to start a new factory, a new office. That's when demand comes in. Demand comes in when people, demand for money comes in, or people start investing when they see demand in the economy. So as I was explaining to you earlier, urban demand is there, rural demand has been weak. A large part of India's population stays in the rural areas, and as the rural economy picks up, that combined with the urban spending, combined with the pay commission hikes, will result in increased demand and therefore higher capacity utilization. And once capacity utilization increases, automatically you will start seeing people investing in new businesses. People starting a new power plant, a new factory for producing some product or the other. And as that keeps happening, demand for money will increase. Okay. If demand for money increases, credit growth will improve.
That will follow. You know, while we're talking about very high bad loans, on the other hand, RBI also, you know, it released its financial stability report recently. It mentions that the corporate stress levels are coming down. That is a trend that they have seen over the last couple of months. In fact, this year, that was a strong trend. And that banks are increasingly lending less to very leveraged corporates. In your sense, is that the experience you've had as well?
I mean, we don't really lend to corporates in that sense, but what I see in the market, I can tell you. Yes, stress levels, I would say that the leveraging levels or the amount of borrowings that banks do, or companies do, that has come down. But that has come down because people are not setting up new businesses. Once economic activity starts picking up and investments start happening in a bigger way, you will see demand for money coming in. Now, the demand for money, whether it's from the same group or the same entrepreneur who's heavily over-leveraged or somebody else, it remains to be seen.
We've seen a lot of financial market volatility in the last few days after the outcome of the UK's
Brexit.
voting against, you know, opting out of the EU. You think these short-term impacts will, you know, peter off in the coming few days? Do you have, given that we have sufficient forex reserves, etc., do you think the impact of the Brexit India could weather and withstand?
I would think so. I honestly believe so. I think the impact on India if Brexit does ultimately happen and Britain does really actually leave the European Union, there will be an indirect impact, but there will not be any significant direct impact. The indirect impact could happen because whenever there is any risk averseness in the system, you always find that there is flight to safety. So money flows back into the US. Ironically, when the US got downgraded, one would have expected the US dollar to weaken and money to move out of the US.
That
On the
didn't
contrary, more money went back to the US.
Yeah.
So US is always considered a safe haven.
Yeah.
And whenever there is a risk-off sort of attitude, money goes back to the US. So you will see dollar strengthening, which we have in recent times. You will see the yen strengthening because of the way the system works, and you will see gold strengthening. So these are the three things which happen. Yen is more because of the carry trades. So as dollar strengthens, it will also strengthen against emerging markets. And whenever dollar strengthens, we see a weakening in stock markets, in emerging markets, because people start pushing money back into the US. So we've seen a little bit of that in the last 2 or 3 days. My sense is RBI has enough reserves. We've handled the currency situation extraordinarily well in the last 3 years. We brought down the volatility dramatically. I remember 2013 and the difficult times everyone was going through, mid 2013, post the Fed comment about rate hike. And that has been managed very well. Also, we built up so much of reserves. So I think there is enough reserves with RBI to manage the currency situation well. I would be less worried about Brexit today than what I would perhaps have been worried had this happened 3 years earlier.
All right, just one last question, Mr. Mistry, on HDFC itself. We've started the new financial year. In terms of the loan growth outlook, which was somewhat slower last year, I know you've explained for various reasons like higher loans sold, etc. What is your outlook? What is your sense? And this year also?
We don't make forward statements, so I'll avoid answering that question, but I'll come back for a moment to last year. What you need to understand is that you should not look at on-balance sheet growth. On-balance sheet growth is determined not just by the disbursements that take place, it is also influenced by interest rates. So the loan that we give to a customer is repaid through an equated monthly installment, and that installment is fixed at the time the loan is taken. The installment has not changed to reflect higher or lower interest rates. Now when interest rates come down in the economy, and obviously we have also reduced our lending rates over time, the interest component of the EMI reduces, because the interest is, the lower percentage is calculated on the loan outstanding at the beginning of the month. So if the EMI remains the same and the interest component reduces, then automatically the principal component increases, which means the amortization is faster. Now the first principle of banking that I learned many years ago was that when you're in the business of lending, the faster the money comes back, the safer it is. So we've not changed that principle. We've not told customers go and pay a lesser amount now, because we don't need so much amount. Money is coming back faster.
I know you do not want to give out numbers, but just a sense that you get as you start this new financial year, would it be a better one?
We've not seen anything today which would make us believe that there is any slowdown in the retail business, in the retail individual housing loan business.
All right, that's Mr.